On July 18, 2024, the IRS finalized Treasury Regulation 1.401A9-5, a 275-page document that permanently altered the inherited IRA rules that tens of millions of American families have been planning around since the Secure Act passed in December 2019. It is not a proposal. It is not a draft. It is final, binding, retroactive to January 1st, 2023, and it contains one specific requirement: the annual required minimum distribution rule for non-spouse inherited IRAs, that the IRS itself had waived for 4 consecutive years while families made financial decisions they now cannot undo. The IRS collected those waivers, then it finalized the rule anyway. Families who inherited IRAs between 2020 and 2023 and took no distributions are now facing a compressed 10-year depletion schedule, annual RMD obligations they did not plan for, and potential penalty exposure that in some households exceeds $140,000. Here is what this video covers: 5 specific inheritance traps, each one created or accelerated by the 2024 final regulations, that are hitting American families right now in the year of settlement before they have had a single conversation with a tax professional. Trap number 1, the 10-year rule annual RMD requirement, the provision that the IRS waived 4 times and then finalized anyway, and the specific calculation that determines how much you must withdraw each year from an inherited IRA, what happens if you miss a year, and whether the 25% excise tax penalty under Section 4974 of the Internal Revenue Code can be abated once it is assessed. Trap number 2, the successor beneficiary trap. What happens when the original inherited IRA beneficiary dies before the 10-year window closes, and how the IRS's 2024 final regulations create a situation where a grandchild inheriting from a parent who inherited from a grandparent faces a distribution schedule that can be shorter than 1 year. Trap number 3, the Roth inherited IRA misconception, a widespread belief that inherited Roth IRAs are completely tax-free and require no planning, and the specific scenario in which an inherited Roth IRA generates a fully taxable event because of a 5-year rule violation that almost no beneficiary knows exists. Trap number 4, the Trust-as-Beneficiary catastrophe. What happens when a retiree names a revocable living trust as the IRA beneficiary without ensuring the trust meets the IRS's see-through trust requirements under Treasury Regulation 1.401A9-4, and how that single drafting omission can compress a 10-year distribution window into a 5-year window or eliminate the stretch entirely? Trap number 5. The state-to-state tax interaction, a provision that 17 states have not updated to conform with the Secure Act or the 2024 final regulations, creating a situation where the federal 10-year depletion rule and the state's own inherited IRA rules produce conflicting distribution requirements that expose beneficiaries to double taxation in the same calendar year. My name is Brockway. I am an enrolled agent with over 20 years of experience representing taxpayers before the Internal Revenue Service, including estate tax matters, inherited IRA disputes, and IRS penalty abatement proceedings in cases involving Section 4974 excise taxes on missed required minimum distributions. What I am about to show you is not estate planning. It is not investment advice. It is survival planning, the specific code-referenced knowledge that protects grieving families from IRS enforcement actions they walk directly into because no one warned them the rules had changed. The protection moves are at minute 21. Do not skip ahead. Catherine and Douglas Merritt are 58 and 61. They live in Columbus, Ohio. Catherine is a high school principal. Douglas spent 29 years as a structural engineer before transitioning to a consulting practice in 2018. They are not retirees. They are the adult children of one. In November 2021, Catherine's mother, Evelyn Pryor, age 79, of Dayton, Ohio, passed away. Evelyn had spent 24 years as an office administrator at a regional insurance company and had accumulated $487,000 in a traditional IRA over her working life. She had named Catherine as the sole beneficiary. Catherine inherited the IRA in December 2021. She was 55 years old, a non-spouse, non-disabled, non-chronically ill beneficiary. Under the Secure Act of 2019, she was subject to the 10-year rule. The inherited IRA must be fully distributed by December 31st, 2031. Catherine called the IRA custodian. The custodian told her she had 10 years to empty the account. The custodian did not tell her that, under the proposed IRS regulations published in February 2022, she might also be required to take annual RMDs during those 10 years, because her mother had already reached her required beginning date before dying. Catherine took no distributions in 2022. She took no distributions in 2023. The IRS waived the RMD penalty for both years. Notice 2022-53 and notice 2023-75. And Catherine assumed the pattern would continue. On July 18, 2024, the IRS finalized the regulations. Annual RMDs from inherited IRAs are required beginning in 2025 for beneficiaries in Catherine's situation. The missed distributions for 2022 and 2023 are permanently waived, but the missed distribution for 2024, the transition year, is subject to a reduced penalty of 10% under the Secure 2.0 Act's revised excise tax schedule if corrected within 2 years. Catherine's required 2024 distribution, calculated using the IRS single life expectancy table and her age at the end of 2022, was $27,140. She did not take it. The 10% correctable penalty, $2,714. If uncorrected within the 2-year window, the penalty reverts to 25%, $6,785, and that is before the income tax on the distribution itself. Catherine and Douglas Merritt did nothing wrong. They followed the guidance they were given, and the guidance they were given was incomplete. This is exactly what is happening to ordinary American families every single day. It is happening now. It is happening this year. It is happening to beneficiaries in every state who inherited IRAs between 2020 and 2023 and have been waiting patiently, reasonably, for the IRS to issue final guidance before acting. The final guidance is here, the clock is running. The Secure Act of 2019 eliminated the stretch IRA for most non-spouse beneficiaries. The prior rule that allowed inherited IRA distributions to be spread over the beneficiary's own life expectancy, sometimes across 40 or 50 years. In its place, Congress enacted a 10-year rule. The inherited IRA must be fully distributed within 10 years of the original owner's death. What Congress did not specify clearly, and what the IRS spent 4 years clarifying, is whether annual distributions are required during those 10 years, or whether the beneficiary can simply wait until year 10 and take everything at once. The answer depends on a single fact: whether the original IRA owner had reached their required beginning date before dying. The required beginning date is April 1st of the year following the year the account owner turns 73. If the original owner died before that date, the beneficiary has no annual RMD obligation. They can take any amount in any year, as long as the account is empty by December 31st of the 10th year. If the original owner died on or after their required beginning date, as Evelyn Pryor did at age 79, the beneficiary must take annual RMDs based on the beneficiary's own life expectancy using the IRS Single Life Expectancy Table in Treasury Regulation 1.401A9-9 with the account fully depleted by the end of year 10. This is the provision the IRS waived for 2021, 2022, 2023, and 2024 via notices 2022-53, 2023-75, 2024-35, and a final transition rule in the July 2024 regulations. The waivers created the widespread impression that annual RMDs were optional or unlikely to be required. That impression was incorrect. Beginning in 2025, annual RMDs are mandatory for all non-spouse beneficiaries who inherited from an owner who had reached their required beginning date. The calculation uses the beneficiary's life expectancy factor from the year following the year of death, reduced by 1 for each subsequent year. Let me tell you about the real people this has happened to. Marcus and Janelle Ossie, ages 54 and 51, of Atlanta, Georgia, inherited a $612,000 traditional IRA from Marcus's father, Harold Ossie, who died in February 2022 at age 81. Harold had been taking RMDs since age 72. Marcus, as the sole designated beneficiary, was subject to annual RMD requirements during the 10-year window. He took no distributions in 2022 or 2023, relying on the IRS waivers. He took no distribution in 2024, assuming the waiver would continue. It did not. His required 2024 distribution, based on his life expectancy factor of 32.3 years from the 2022 single life expectancy table, was $18,948. Uncorrected within 2 years, the penalty is $4,737. The IRS will also treat the failure as a filing deficiency, which can trigger an automatic 20% accuracy-related penalty on the resulting underpayment if the distribution income was not reported on the return. The sublist of annual RMD calculation steps every inherited IRA beneficiary must execute identify whether the original owner died before or after their required beginning date. If after, obtain the original owner's life expectancy factor from the IRS Uniform Lifetime Table as of the year of death. Calculate the beneficiary's own life expectancy factor using the IRS Single Life Expectancy Table in Treasury Regulation 1.401A9-9 using the beneficiary's age in the year following the year of death. Use the lesser of the two factors as the distribution period. Divide the prior December 31st account balance by the applicable distribution period. Reduce the factor by 1 for each subsequent year. Confirm the 10-year end date and plan distributions to fully deplete the account by that date. Missing even one annual RMD exposes the beneficiary to the Section 4974 excise tax. 25% of the shortfall, reducible to 10% if corrected within the 2-year correction window established by the Secure 2.0 Act. The 2024 final regulations introduced a provision that has received almost no coverage in mainstream financial media, and that is already generating the most severe distribution compression scenarios in inherited IRA history. The successor beneficiary rule governs what happens when a designated beneficiary, a person who inherited an IRA and is subject to the 10-year rule, dies before the 10-year window closes. Under Treasury Regulation 1.401A9-5D, a successor beneficiary, the person who inherits the already inherited IRA, is not entitled to a new 10-year window. The successor beneficiary steps into the original beneficiary's remaining time. If the original beneficiary had 4 years left in their 10-year window when they died, the successor beneficiary has 4 years, regardless of their own age, regardless of their relationship to the original owner, and regardless of whether they had any awareness that they were inheriting a time-constrained asset. The specific scenario that is generating 6-figure tax bills. A parent inherits a $400,000 IRA from a grandparent in 2021. The parent is subject to the 10-year rule. The window closes December 31st. 2031. The parent dies unexpectedly in 2028. An adult child, the grandchild of the original IRA owner, inherits the remaining balance as the successor beneficiary. That grandchild has 3 years to distribute the full remaining balance. On a $380,000 inherited IRA balance, $126,667 per year for 3 years represents a substantial income tax event, potentially pushing the successor beneficiary into the 32% or 35% federal bracket for each of those 3 years. Let me tell you about the real people this has happened to. Teresa and Patrick Quinlan, ages 49 and 52, of Providence, Rhode Island, received a successor beneficiary notice in early 2024 after Patrick's mother, who had inherited an IRA from Patrick's grandmother in 2020, passed away unexpectedly in late 2023. Patrick's mother had taken no distributions from the inherited IRA in 2020, 2021, 2022, or 2023. The account had grown from $318,000 to $341,700. The 10-year window closes December 31st, 2030. Patrick and Teresa have 6 years to distribute $341,700. That is $56,950 per year, added to Patrick's existing engineering salary of $94,000, pushing their combined household income to $150,950 in each of the next 6 years, with a marginal federal rate of 22% on the IRA distributions alone. Total additional federal income tax across 6 years, $75,180 on money Patrick's grandmother saved over 30 years. The protection move for successor beneficiary situations is a disclaimer strategy, a formal legal disclaimer under IRC Section 2518 that, if executed within 9 months of the original beneficiary's death, allows the successor beneficiary to redirect the inherited IRA to an alternate beneficiary with a more favorable tax profile or a longer distribution horizon. I will give you the specific steps at minute 21. Most beneficiaries who inherit a Roth IRA believe the distributions are completely tax-free. In most cases, they are correct, but there is one specific scenario almost universally overlooked, in which an inherited Roth IRA distribution is fully taxable as ordinary income. Under Section 408A, D, 2, B of the Internal Revenue Code, distributions from a Roth IRA are tax-free only if the account has satisfied the 5-year holding period. That period begins on January 1st of the first taxable year for which the original owner made a Roth IRA contribution or completed a Roth conversion. If the original owner died before the Roth IRA satisfied its 5-year holding period, and the beneficiary takes a distribution before that period is met, the earnings portion of the distribution is fully taxable as ordinary income. Here's the scenario generating unexpected tax bills across the country. An individual converts a traditional IRA to a Roth IRA in 2022, motivated by the low tax rates available in that year. They die unexpectedly in 2023. The Roth IRA has been open for approximately 18 months. The 5-year holding period has not been satisfied. A beneficiary who takes a distribution from that inherited Roth IRA before January 1st, 2027, the date the 5-year period would be satisfied, will owe ordinary income tax on every dollar of earnings distributed. On a $240,000 Roth conversion that grew by $28,400 before the owner's death, a beneficiary who distributes the full account in 2024 owes ordinary income tax on $28,400, potentially $6,248 to $9,939 in federal tax depending on their bracket, on money they believed was completely tax-free. The protection move is a Roth conversion date verification, a specific inquiry to the IRA custodian that establishes the exact opening date of the Roth account and confirms whether the 5-year holding period has been satisfied before any distribution is taken. I will show you the exact question to ask at minute 21. Naming a trust as the beneficiary of an IRA is a common estate planning technique used to control distributions to minor children, protect assets from beneficiary creditors, or coordinate IRA assets with broader estate documents. When done correctly, it is effective. When done incorrectly, it converts a 10-year distribution window into a 5-year window, or eliminates the stretch entirely. Under Treasury Regulation 1.401A9-4, a trust named as IRA beneficiary can be treated as a see-through trust, allowing the IRS to look through the trust to the individual beneficiaries and apply the same rules that would apply if those individuals had been named directly. For see-through treatment, the trust must satisfy 4 requirements. It must be valid under state law, it must be irrevocable, or become irrevocable at death. All beneficiaries must be identifiable individuals, and the trust documentation must be provided to the IRA custodian by October 31st of the year following the year of the owner's death. If any one of those 4 requirements is not met, the trust is not a see-through trust. The IRA is treated as having no designated beneficiary, and an IRA with no designated beneficiary that belongs to an owner who died after their required beginning date must be distributed over the owner's remaining single life expectancy, typically 5 years or less. The specific drafting error generating the most cases, a revocable living trust, the most common estate planning vehicle for American families that includes discretionary distribution language allowing the trustee to accumulate income rather than distribute it to identifiable individuals. That accumulation language disqualifies the trust from see-through treatment under the IRS's conduit trust versus accumulation trust analysis. The dollar consequence, a $520,000 IRA compressed from a 10-year distribution window to a 5-year window, generates $104,000 per year in required distributions instead of $52,000 per year, doubling the annual taxable income of every beneficiary for 5 consecutive years. The federal estate tax exemption for 2024 is $13,610,000 per individual, $27,220,000 for a married couple with portability. For the vast majority of American families, there is no federal estate tax, but 17 states, including Massachusetts, Oregon, Minnesota, Illinois, Maryland, and Washington, impose their own estate taxes with exemptions as low as $1 million. Here's the collision. In those states, inherited IRA assets are included in the gross estate for state estate tax purposes at full fair market value before any income tax on the distributions. When a beneficiary then takes distributions from the inherited IRA over the 10-year window and pays federal and state income tax on those distributions, they are paying income tax on assets that were already subject to estate tax at death. The federal tax code provides a partial remedy, the estate tax deduction under Section 691C of the Internal Revenue Code, which allows a beneficiary to deduct the estate tax attributable to income in respect of a decedent. But that deduction applies only to federal estate tax, not to state estate tax. In states with their own estate tax, the state-level estate tax paid on the IRA assets is not deductible by the beneficiary when they take distributions. The specific dollar consequence in Massachusetts, which has a 16% top estate tax rate on estates above $2 million, a $400,000 inherited IRA in a $2.4 million estate generates approximately $32,000 in Massachusetts estate tax attributable to the IRA. Over the 10-year distribution window, the beneficiary then pays Massachusetts income tax of 5% on every distribution, totaling $20,000 in state income tax on the same $400,000. The state-level estate tax is not deductible against the income tax. Total state-level tax on the same $400,000, $52,000. Federal income tax at 22%, $88,000. Total combined tax on a $400,000 inherited IRA in Massachusetts, $140,000. 35 cents of every inherited dollar gone. The protection move here is a state-specific distribution planning analysis, a calculation that identifies whether accelerating distributions in lower income years reduces combined federal and state tax below the alternative of spreading distributions evenly across 10 years. In high state tax environments, the answer is almost always yes. Here are your 5 protection moves, one for each trap. Every one of them is available to you right now, and every one of them becomes more expensive the longer you wait. If you inherited an IRA between 2020 and 2023 from someone who had already reached their required beginning date, meaning they were 73 or older when they died, or 70 and a half if they were born before July 1st, 1949, you must calculate and take your 2025 annual RMD before December 31st, 2025. Use the IRS Single Life Expectancy Table in Treasury Regulation 1.401A9-9. Find your age in the year following the year of the original owner's death. Divide the prior year-end balance by that life expectancy factor. That is your minimum distribution. Take it. Then reduce the factor by 1 for each subsequent year. If you miss the 2024 distribution, file IRS Form 5329 and request penalty abatement under the reasonable cause exception. The IRS's own 4-year waiver history is documented grounds for abatement. Do not wait. If you are a successor beneficiary, meaning you inherited an IRA from someone who had already inherited it, contact the IRA custodian immediately and confirm the original 10-year window end date. Then consult an enrolled agent or estate attorney about whether a qualified disclaimer under IRC Section 2518 is still available. A disclaimer must be filed within 9 months of the date of the transfer, not the date you learned about it. If the window is still open, a disclaimer can redirect the account to a beneficiary with a longer tax horizon and save tens of thousands of dollars in compressed distribution taxes. If you inherited a Roth IRA, call the custodian today and ask one specific question. What is the date the Roth IRA was first established or converted? If the answer is within the past 5 years, do not take any distribution until the 5-year holding period is satisfied. The earnings in the account are taxable until that date. The principal, your proportionate share of contributions and conversion amounts, is always tax-free. A custodian can provide a breakdown of the account's basis versus earnings. Get that breakdown in writing before you take a single dollar. If you have named a revocable living trust as the beneficiary of your IRA, or if you are inheriting an IRA through a trust, request a copy of the trust document and bring it to an enrolled agent or estate attorney for a see-through trust compliance review this month. The specific question is, does the trust contain any accumulation language that permits the trustee to retain income rather than distribute it to identifiable individuals? If yes, the trust may not qualify for see-through treatment, and a beneficiary designation change, executed while the IRA owner is still living, can correct the problem before it becomes a 5-year compression event. If you live in, or your parent lived in, Massachusetts, Oregon, Minnesota, Illinois, Maryland, New Jersey, Washington, Connecticut, Rhode Island, Vermont, Maine, Hawaii, Iowa, Kentucky, Nebraska, Pennsylvania, or New York, Retain a tax professional to run a state-specific inherited IRA distribution analysis before you take your first distribution. In high state tax jurisdictions, the sequence and timing of distributions can reduce total combined tax by $18,000 to $40,000 over the 10-year window. That analysis costs $300 to $800. The tax it saves is 20 to 100 times that amount. And now the bonus move. I call this the Inherited IRA Tax Compression Shield. It is a 3-document package: a distribution schedule, a state tax interaction worksheet, and a beneficiary audit checklist that every family with an inherited IRA or an IRA they expect to inherit should have completed before December 31st of the current year. The distribution schedule maps every required and optional withdrawal across the 10-year window, identifying the 2 or 3 years where income from other sources is lowest, and front-loading or back-loading distributions to keep the household tax rate at 12% or below in every year of the window. Combined with the state tax interaction worksheet, this structure can recover $40,000 to $90,000 in tax savings on a $400,000 inherited IRA that would otherwise be distributed on autopilot. I have documented the complete methodology, including the annual RMD calculation walkthrough, the see-through trust compliance checklist, the Roth 5-year verification script, and the Successor beneficiary disclaimer timeline, in a 52-page guide that is completely free. The link is in the description below. In the next video, I am going to show you a provision inside the Secure 2.0 Act, Section 327, that allows surviving spouses who inherit an IRA to elect to be treated as the deceased spouse for RMD purposes. It is the single most powerful inherited IRA tool available to married couples in 2024, and fewer than 3% of surviving spouses who qualify for it have ever used it. If you are married and either spouse owns an IRA, that video is not optional. Share this video with an adult child, a sibling, or anyone who has inherited or expects to inherit a retirement account in the next 10 years. The IRS finalized these rules in July 2024. Most families still do not know. Like this video. Subscribe to this channel. Every year that passes without a distribution plan is a year the IRS is writing the plan for you.